Welcome, guys. Welcome to. I think it's been months. I think the last time I held a Zoom meeting was in. I think that was like November last year. November last year was the last time actually. Basically, I I've just been seeing a whole lot of things happening in the forex market for a while, and it's been shady to a lot of traders, and they're still trying to understand what's actually happening with the market. So it's one of the major things I'm also going to be trying to clarify today, specifically, apart from just technical analysis. You see, one of the biggest misconceptions about trading is they make you they make you believe that technical analysis can do everything you want. Like once your technical analysis is right, it means you're in control. But the truth about it is even the banks themselves, even your hedge funds, your big players in the forex markets, they don't just trade based on technical analysis. You see, that's why you have three types of trading. You have technical analysis, you have fundamental analysis, you have sentiment analysis. Now, the whole idea of sentiment is the combination of your fundamental and your technical analysis. So simply meaning that what you see on your chart combined with what it is outside the chart is what builds the sentiment. So you don't just see how to call it. You don't just see, let's say for instance, you see it looks like market is about to change direction technically, but then you want to take a trade. You don't just jump into the trade. You want to understand what is the likelihood of this actually happening. Do you get? You want to know, okay, if this happens, is it going to affect my technical analysis? Is my technical analysis going to be violated, or is it going to be in line with what is happening presently, fundamentally? Now, sometimes when people say fundamentals, the only thing they think about is just, macroeconomic news that happens, maybe your weekly economic calendar events. Whereas there are a lot of other things to look at fundamentally. Things like, is the economy of this country strong or is it weak? Is it the struggling economy, or is it a safe haven economy at the present time? So those little fundamental knowledge can actually really help you. You also want to know what kind of pairs are correlated. So you have, one of the biggest correlations of all time is between the NZD-JPY and the GBP-JPY, which is ranked at over 93% correlation. Things like that. So you don't take a trade on GBP-JPY and then you're taking CHF-JPY expecting that, or USD-JPY expecting that the correlation is going to be, that much. The reason why the correlation between the USD-JPY and the GBP-JPY is very wide apart is because of, the trading session between the USD and the GBP. Okay, so little fundamental knowledges like that could also help you. Also, another very, very key fundamental knowledge that is important for we as traders to have is understanding that the market isn't run by you. Okay, there's the term market makers, and I'm sure a lot of us have heard that market makers, market makers, market makers. Who exactly are the market makers? See, market makers are the banks, the hedge funds, the people who have the high voluminous amount of money to actually trade in the market. You heard the forex market is a $21 trillion market every day, or is it $18 trillion market every day? We all know, me and you and 10 million others of us put our money together, we still can't make up a trillion. But these banks, these hedge funds, they are constantly in transactions, so they are the money. Now, because they have a larger part of the money, we rather in the market, we are takeaways, basically, or liquidity in the market. That's one thing you should know. As an individual trader that you are forever going to be a liquidity in the market, because your money barely makes up 0.01% of the total money in the forex market. So you are always just going to be a liquidity. So you also have to have this fundamental backing and then understand how the market works. It's not just about highs and lows. Okay, you have highs, you have lows. There could be manipulations also in the market. So when you understand why these manipulations are created, it also gives you, an edge into your trading. Now, why did I start out with all these things I'm saying? Is because I'm going to be showing us a few things that has happened to me over the years in my course of trading, and a few mistakes, okay, I've learned from the market. And one of the major mistakes is thinking that it is supposed to be the way it is in the book you read. It's a fallacy. You know those beautiful chart patterns you see where you see double bottoms and they tell you it's a straight buy, you see double tops, they tell you it's a straight sell, you see bullish flags and they tell you once it does 1, 2, 3 touches, it breaks out and retest and all of those technical patterns. But you also need to just keep in mind that it really is not so. Okay, so today I hope by the time we're done analyzing the charts, we'll be able to start to view the market a little bit differently. So let's start with the euro dollar today, the analysis on the euro dollar. So I'm going to be looking at the euro dollar from the weekly time frame. So on the weekly time frame, let's even go to the monthly. Okay, so on the monthly time frame, we see the euro dollar approaching a very, very key demand at the 103,600 region. Okay, 103,600 region and the 107 region. Now we can see this level acting as a very, very, very strong demand level from the monthly, which was around December 2016, before it pushed prices all the way to another monthly high, which is at 1.25549. Now we see prices again also approaching this same level. How many years later? 6 years later, prices finally get into this level. Okay, so now this area here becomes a very, very key level, becomes a key demand level, not just your normal demand levels that in your smart money, but we're talking about key fundamental level. Okay, it's not just a level, it's also a psychological level, simply meaning that everybody has their eyes on this level presently in the market. We're talking from big forex traders, we're talking of hedge funds, we're talking of the banks themselves. Everybody have eyes on this level presently. Now, that's my biggest concern so far about the Euro USD. The Euro USD has been on this level for 3 weeks now. Okay, after this week, it's going to make it approximately it's going to make it about this is going to make it its 3rd week. I think it's 3rd week or it's 4th week that's been on that level. Now, my question here is that level is so strong that it is supposed to have pushed prices in a week to a high point, at least. But so far, since then, prices have just been on that level and has refused to change structure. Now, my sentiment on this is there's always a reason to why things don't happen the way you want them to happen in the market. Over the years, I've seen it happen not once, not twice. It's happened to me before. I remember Euro GBP. I could see clear chart patterns that were supposed to push prices to the upside, but then what happened? I ended up getting wiped out of the market. Now, my belief here is we had this very, very significant candle. And if you know what this candle is, then you know why I call it very significant. Okay, this is a very long rejection from a monthly level. And still yet, prices failed to break above this daily key level at this area. And instead, what happened? Prices started to sell from this level. Now, if you go to the daily and you look at the daily, you'd also figure out that where prices couldn't break also stand as a very, very important level for the Euro USD, which is the 1.055897 region, this level here. And then prices did what? Prices kept pushing backwards. Now, if you look at the overall trend, we're in a bear market. Okay, the order flow is still respected. When I mean order flow, I mean the structure is still respected. We're still making series of what? Higher highs and lower highs and lower lows. Okay, now it's still in motion. As you can see, we had this high was created, this low was created, then we have a lower high again, but prices fail to break this level. Now, that is where it's tricky for a lot of people. And everybody is beginning to think, oh, we possibly might have a triple bottom or we have a double bottom again and all of that. But I don't see it that way. And why don't I say it that way is because the fact that this key level here from the monthly and the weekly is holding, it simply is, for me, could be a trap. And why did I say it's a trap? Like I said on my status, on my WhatsApp status and I think on Telegram, it is easier to trap. Okay, it is easier to trap people. It is easier to trap people when there is a pre-programmed, pattern that they tell you is never going to fail. Now, everybody is expecting buys from here, but think of it this way. What if there is, in fact, not what if, there is a lot of stop losses around this area. A double bottom was formed here. People would have taken their trades at this level. And then what do you have? You have series and series and series of stop losses all around this level. All around this level. Now, if you really understand how the banks work and how these big market players work is, your money is what they use to fuel the market. So they're constantly wanting to hunt everything you have. They just want to take from you. It's how your brokers make money. Okay? It is how they earn, even your brokers as well, is how they earn from the market. So my bias on this year, sentiment, that is considering the fundamental and technical analysis. Yes, there's a double bottom. Yes, price is a very, very key demand. But the fact that it's a key demand for me is a psychological level is why I'm scared of it, because it's why it's called psychological level. It's an opportunity for them to trap you. Your mind is hand-bent on, this is going to buy. There's nobody at this point in time that is wanting to take a sell at this place. And that's why I have a lot of sentiment about it, because it has happened to me not once, not twice, but severally. So what I'm saying, or what I feel, is prices are likely to come here, clear liquidity at this level before it starts moving to the upside. It's a high chance. But if prices fail to move downwards to take out liquidity, then my best possible place to buy would be after prices break this level. When prices can clear this level, I can then begin to confirm that, okay, we are gradually entering into the bull season for everything against the dollar. And significantly, if you've been looking at the market for a while, the dollar has been gaining a very, very suspicious sort of strength. Considering the fact that, you know, the economy is presently in a recession, you know, stocks are falling, you wouldn't expect so much of the dollar. But somehow, some way, the dollar has been gaining strength for no reason. And that's suspicious. Those are little things that, as a trader, you should also be able to look out for. You need to look out for those things that look very, very suspicious, because when you don't see them and you can't recognize them in your trading, and you just stick to only technical analysis at every time, things like what you call manipulation, stop hunts, and whatnot is always going to be your portion in the market, of which, yeah, I reject that for you. So that's my basic concern about Euro USD, because I've had a lot of people tell me, oh, please check Euro USD. I think it's going to buy. I can see a double bottom. Yeah, I saw the double bottom as well, and I took buys from it. I took buys from this point of the double bottom. But when it got to this level, I then realized, okay, it's messed up, because after plotting my trading style and respecting the rules of order flow, I then realized, okay, this is messed up. And I'll give you an example. When you look from here, you calculate this, you can see that prices stopped at exactly the 61.8. So prices could not fulfill to break above premium. It was still around this level and then started pushing downward. So when I saw that immediately, I just knew, okay, I had to back off my buys and wait till I could see prices start to do what? Start to break highs. So we could just keep getting a range in this level. It's very possible. We could keep getting a range in this level. Prices have, I feel like, not like I feel, I just know, I don't know why, but it's a strong instinct, okay? You can do your own research. Remember, it's just the same chart, but everybody with different analysis, and yours could play out and mine could not play out at all. Since we're talking about mine, I'm telling you what it is. I feel prices is really going to want to clear liquidity, because I know there is a lot of liquidity here. There are a lot of stop losses. There are a lot of pending orders at this point, and prices would have to pick them, move, clear this liquidity, possibly, and then we finally will get that bull run. But for now, I'm still very much bearish on anything against the dollar. So let's open the DXY quickly. So look at it. You can see on the DXY weekly has been on a crazy bull run. Even at this point, some weeks back, I think 3 weeks back, before the FOMC readings and meeting, we all felt like, okay, it was time for the dollar to crash. I was expecting the dollar to crash to this level at least before any reversal, or possibly even crash and break for us to see a continuation of the dollar losing strength. But it failed. Instead, what did we have? We saw prices do what? We saw prices retest a broken weekly area, and see, we finally saw the DXY creating what? New highs, showing a whole a whole lot of, dollar strength at this level. Now, this got me suspicious to try to look into why the dollar is still appreciating, regardless everything the economy is going through. They're presently suffering through a recession. The stock market is in a depression. All of these things, but yet it's still moving this high. So it's a bit tricky for anybody to just ignore. So until I can finally start to see, bearish momentum on the dollar, until the bears can come in for the dollar properly, I'm always going to just be on the side of the dollar. So anything, let me put up the text here. Okay. So this is my bias on the USD. Okay. So anything against the USD still sells for me, and the USD against anything is still very much bullish for me. So unless I finally get that, that bearish momentum from the dollar, I'm still very much bullish against anything. I'm still very much bearish at anything against the dollar for now. So from Euro USD to GBP USD to NZD USD, AUD USD, I'm all bearish on them. Now, this is another big major player for me this coming weeks, XAU USD. The XAU USD is a big player for me this coming weeks. So I've seen a lot of people waiting for buys on the XAU USD, and I keep looking at this chart and I'm like, what exactly can we all see on this chart? Like, it's evident. This is a double top on a weekly level. This is a double top on a weekly level, after creating an all-time high. Now, one major problem I have with a lot of traders is we tend to not identify patterns. When I mean patterns, I'm not talking of chart patterns. I'm talking of the market always presents you with patterns. You see, when I started learning Forex, there was something I would always read is Forex is your ability to spot historical data and make use of them to your advantage. Now, it's not just about your 1 hour chart, your 4 hours chart. No, we're talking about looking at real currencies and understanding how these financial markets work. Let's take, for instance, BTC USD. BTC USD always does a very strong dump every time it creates an all-time high. Now, the whole essence of an all-time high to be created is so the market can be corrected for more people to get into the market. So it's the same basic understanding of market structure. For every impulse, there's a correction. And if you're on a buy trend, you then understand that after the correction, what happens? An impulsive move has to be there, which is going to take out the previous high. That is how all-time highs are created. Now, simply put, for every all-time high that is created, there would have to be a correction. A correction is what most people call the dip. It's just a correction. It's not the end of whatever commodity it is you're trading. It's a correction. Now, once you keep this in mind, then recognize patterns. It has happened in not just gold. It has happened in USD ZAR. It has happened in Euro USD. It has happened in the JPYs. It has happened in BTC. It has happened in Ethereum. It has happened even in Tesla. It has happened in Amazon. It has happened in Microsoft. These are patterns that you have to recognize. They help you keep your mind clear and fact in on what is supposed to be. Now, we recognize that an all-time high has been created on gold here. This was the highest gold ever went in 2011, which was at 1905, and then we see prices come all the way to 2070. Now, prices didn't just only come all the way to 2070. It got to 2070, pulled back, and even tried to do what? Go above it, but failed to. That's basic fundamental. Now you then understand that there are bear powers in this market. This is a weekly chart we're looking out for. Twice, and every time prices came here, you can see what it did. It didn't just stop. We saw the first time that when prices came here, what happened? We had a massive bearish engulfing candle on the weekly here. Prices went back in there. We had this massive shooting star. You can clearly see the rejection. We had a rejection of over how many pips? Let's count this. We had a rejection of over, I think this is over over 800 pips and 800 pips rejection. And this is a clear double top. You even have your neckline stipulated at this area here. Now, not just am I seeing only this, I'm seeing prices actually breaking out of this up, trend that took prices back into the supply region. Prices doing what? Breaking it, and prices doing what? Retesting the same trend here. And now look at it. I always pay attention to my candlesticks, like very close attention to them. If you look at what we have here clearly, what do you see? We have an engulfing. If you look at this level clearly, if you look at this candle here, what do you see? We have an indecision candle. So we had an indecision candle. That's first of all, there was no decision after prices broke this trend line. Now, after prices broke the trend line, we have a bullish move. We had a bullish move. Prices still couldn't go back. Then we had this indecision candle. What do indecision candles mean? There's been a struggle. It's just indecision. We don't know where we want to go to. We had another bullish candle, tried to go up on the weekly. And then what then happened? We had a bearish candle. The bearish candle did what? The body of this bearish candle engulfed the body of this bullish candle. And as well did the week also engulf this week. So this is a full engulfing. So by the time you check it on your daily, you're going to see long bullish moves that have overshadowed, long bearish moves that overshadowed these bullish moves. That's key. Now, what happened? The next candle also opened bearish, which has not happened in a very long time before this indecision candle. So this shows me bearish strength. It shows me a whole lot of bearish strength in the market. Now, let's scale down to our daily charts. When you scale down to your daily charts, you then realize there's a bearish pattern here. There's a bearish pattern. And let's look at this. When prices rejected here, what happened? Prices tried to pull back up to break above the premium region, but it failed. Where did it stop at? It stopped at our 61.8 level. And if you know what your 61.8 level is, using your Fibonacci very well, you know it is the key level for any retracement. Most corrections don't usually, if you're going to find the proper correction, they usually don't go more than 61.8, except when you have an unmitigated supply level, maybe at your 0.786 or just slightly above your 61.8. Then most times you have a candle weak to 61.8, pick the unmitigated supply and then drop down. But then 61.8 is very key. Now, prices got to your 61.8 and did what? Started moving down. Now, if you also use chart patterns, candlestick chart patterns very well, you will be very familiar with one of the chart patterns that we can see here properly, which is the bearish flag pattern. Now, if you see this, you see we've done 1, 2, moved, and we did what? We finally broke below this channel. So when I posted on my Instagram story and I said, I feel the bears are finally going to come into the market, was I felt they needed to symbol us something. Now we've had prices fail to break above this high. Prices stopped at the 61.8 and then did what? Now it's giving us a bearish flag pattern. So confirmations over confirmations over confirmations is what does what? Is what builds confluence at the end of the day. And that's what we are always looking for, confluence in the market. We're constantly looking for confluence. Now you can see when it broke out of this trend line, look, it had 1, 2, 3. Remember I said the bulls kept trying to go back up, but they couldn't. 1, 2, 3, and then look at that bearish candle we're talking about. You can see it's one massive bearish candle was engulfed. All of this, all this move that was trying to happen here, it was just one bearish candle. Now this speaks a lot about bears in the markets. Take a look at the whole of this part. You have more stronger bearish candles than you have of the bullish candles. Always pay attention to your candlestick. See, when you're in a bullish market, you would have stronger bullish moves. You would always have more strong bullish candles. It's going to be hard for you to be in a bullish market and see more bearish candles. That doesn't make sense. Like literally, if you think of it, you can't say, oh, I'm in a bullish market, but there are more bearish candles. And then the bullish market, then bullish candles are then very tiny. They are this small. And then they are moving upward. If you're in a bullish market, and you start to realize that the bullish candles in the market are starting to, midge it up. They're getting smaller. That's already starting to show you sign of weakness. Simply trying to tell you that the bulls are getting weaker and you should be careful of whatever area it is you're on a buy. That's what it's basically trying to tell you. So at that point in time, momentum, bullish momentum is beginning to disappear. So you should start, moving out of the market. And what I just said is one of the simplest way to know when to take your profits, especially if you're the kind of trader that takes trades without take profits and all of those things. Once you see momentum start to reduce, take your money and run. Don't try to say, oh, it's going to come back, it's going to just retrace. Now, if it was going to retrace, you still have bigger bullish candles and bearish candles. So the same thing here. If you look closely, you can identify that there are more stronger bearish candles than the are bullish candles. So if you're looking for buys on gold, I think you should be very careful with how you're considering it. You really, really should be very careful. Okay, you possibly might get the buys, but I don't think it's going to last long. I honestly don't think it's going to last long because, as you can see, we finally broken out. I believe we have an unmitigated region of supply around this area here. So prices might dance within this area. Possibly might even see dancers in this area. So if you're a short-term trader, you like to scalp, you might get buy opportunities into this area before it starts to pull back down. So like I said, I am still very much bearish on anything against the dollar and bullish the dollar against anything. So that has been my bias this week on the Euro USD and the XAU USD. So I just wanted to start with this. And then, so now I'll be taking questions.